you so much. Let me start by thanking the organizers for putting us on this program and giving us the opportunity to present our work. This is joint work with Thomas Grünthaler, who is a fellow PhD student here in Münster, as well as our supervisor, Nicole Branner. So Emanuel has already alluded to this. We will pretty much stay in this greater realm of FOMC announcements and uncertainty. And we'll switch towards the index side of the market. So to briefly motivate what we're looking at, well, it has been established in the literature that FOMC meetings seem to move the stock market in seemingly puzzling manners. For example, Lucca and Moench in 2015 have shown that a large fraction of the equity premium is realized in a narrow 24-hour window before FOMC announcements. And they also show that this period is not really of any unusually high risk. More recently, Hu et al. In this year have shown that this can be rationalized by looking at uncertainty, and they find that uncertainty increases ahead of FOMC meetings and then gradually resolves, which coincides with this pre-announcement drift period. So it seems to be that uncertainty plays an important role around monetary policy announcements, but what is lacking so far, I think, is a clear story as to why this might be, and we try to tackle that. So our paper basically revolves around one central research question, which is twofold, so made up of two parts. How and why does economic uncertainty react to FOMC meetings? We will try and answer the first part by looking at the behavior of economic uncertainty around these monetary policy meetings in the US. And what we will find is that this pattern that we observe, so this increase in uncertainty and most importantly, the resolution of uncertainty at the announcement time, is basically only driven by the perception of downside risks, which we dub as tail uncertainty. And the second part of the question, so why does it react? We try to answer by using tail uncertainty and looking at the connection of tail uncertainty and the reaction in the stock market to monetary policy announcements, as well as whatever the Fed is doing. So we try to look at policy changes, which we proxy by looking at target rate changes here. And we try to figure out if there's any connection between the two. And we indeed find that tail uncertainty is a very strong predictor for both. So it positively predicts stock market returns around these announcements, and it predicts rate cuts going further. All right. Now, I also wanted to basically give an intuition as to why this might be important from the standpoint of the Fed, and figure out whether the Fed is actually, relating to topics of uncertainty and, more importantly, about downside risks in their day-to-day talk. Now, very obviously they do. So this is a quote from the Fed's FAQ on their website regarding their policy objectives, in which they state that through clarity in policy communications, the Fed strives to reduce economic and financial uncertainty, and this in turn should help increase the effectiveness of monetary policy. And a little more related to this tail uncertainty part that we are looking at, right here is a quote from the meeting of March 2013, a quote by Mr. Plaza, who argues that, rates of return in assets are uncertain. They have to keep that in mind as the Fed, but also that one of the key lessons from the crisis is that the Fed, have to learn to take tail risks seriously. So, this seems to be a subject of discussion at the Fed. So this is why we're looking at this. There are numerous other examples of discussions about uncertainty and tail risks in general taken from meeting minutes. All right, so what we do is we estimate uncertainty by relying on a very liquidly traded financial market, namely the options market on the S&P 500. And we first measure overall economic uncertainty for a fixed horizon, which we fix at 30 days. So we're looking at a rather short-term uncertainty measure by following the standard VIX formula, which we adapt a bit to make it more robust at a high frequency and account for some of the irregularities that you have at a very high frequency. And we next also focus on the impact of tails, and that we follow Boleslav et al. In their 2015 paper, and isolate the variation stemming from left and right tail events going forward under the assumption that option prices follow a certain jump compensator, and there's some other assumptions. Yeah, that we do to focus on the impact of tails and to get a measure of left and right tail uncertainty. Now, I've already talked about the use of options data, and we use minute-by-minute option data from the CBOE. Now, Emanuel has already said that availability here is a bit limited. The availability starts in 2004, and this analysis goes through 2017. And in our data set, we have on average 230 out of the money call quotes and 780 out of the money put quotes per minute. So it's a rather large data set. We also check some of the liquidity measures to check whether FOMC days and non-FOMC days are comparable in this market. And we find that bid-ask spreads and open interest is virtually the same on these two sets of days. So we argue that, you know, making inference using these option quotes on both days is definitely doable. And in this sample, we're left with 112 FOMC meetings. Now, I will next talk a bit about our identification strategy. Now, to do so, you know, we want to look at the behavior of uncertainty around monetary announcements. And for this, we define a treatment group, which is made up of the announcement days themselves, which we denote as F right here. We also include the day after the announcements to possibly look at persistence of any effects, but we do not discuss this too much today. And we also include the 5 trading days before the FOMC announcement to look at what happens to the market of uncertainty leading up to the announcement itself. And these 5 days are quite intuitive in our setting because these 5 days actually comprise the blackout period, which is the 1 week before an FOMC announcement is made, in which committee members must refrain from publicly disclosing any information regarding the upcoming meeting. Now, to basically understand if there are differences in our uncertainty estimates within the treatment group compared to a baseline, we loosely follow Boleslev et al. In their 2018 paper and employ a different diff estimator, where we compare our uncertainty measures in the treatment group to a fixed baseline uncertainty, which we simply define as the average uncertainty in the 30 calendar days before each treatment group. So we compare our uncertainty measure to this control group. And at the same time with this, we purge our estimates from intraday effects. How? Well, for each, say for a very common announcement time of 2 p.m., we would take the uncertainty measures at 2 p.m. on each day in the treatment group, and then compare this uncertainty measure with the 30-day previous 30-day control group average uncertainty measured at 2 p.m. Right, so this is to kind of get rid of some of the somewhat deterministic intraday effects in our uncertainty measures. And down here is the formula that we use for that. So when we do this, this is the picture that emerges. So right here, I've plotted on the x-axis the days in our treatment group. So again, the blackout period, the announcement day itself, as well as the day after the announcement is made. And on the y-axis, you see this diffed uncertainty estimate. So if we start at the beginning of our treatment group, a reading of -2 right here, -2% would suggest that at this time, on average in our treatment groups, so across all 112 meetings, our uncertainty estimate right now is 2% below the control group. And what we find is a very interesting pattern, I think. So at the start of the blackout period, so for the first 2 days, we see that, you know, uncertainty kind of lingers around the control group levels, but then actually increases heavily on day -3, going from about 2% below the control group to around 4% above the control group on day -2. So again, we see this, you know, strong increase in uncertainty, which stays elevated, gaps down on the announcement day, which is quite interesting, and then gaps once again at the announcement time. This is the you know, high frequency resolution of uncertainty, if you will. and then reverts back to control group levels. So I guess this picture kind of neatly shows why looking at a broader picture when considering uncertainty is important, because only considering this announcement drop right here would leave out this entire build-up in uncertainty that we see a few days before, which is very likely driven by the FOMC announcements. So what we then do, what I've alluded to before, is that we want to look at the impact of tail uncertainty. And to do this, we now move away from simply looking at average plots, but we employ a set of dummy regressions, which then capture the average effects for subperiods that we consider. The subperiods are here given in this vector D. We define one dummy for each day in the blackout period, one dummy for the day after the announcement, and then split the announcement day in two. So pre is the dummy that captures the average effect across all meetings before the announcement is made, and post the effect that happens after the announcement is made. So with this, we can kind of look at resolution of uncertainty effects due to the announcement itself. What we also do in this setting is we include a set of control variables, if you will, or variables of interest rather. In the first regression setup, we set this variable x to 0, so we leave out any controls. This is basically the analysis that you've just seen in a dummy setup. And in our second setup, we now include left and right tail uncertainties. Again, relative, these are already purged and relative to the control group. To test significance, we rely on a bootstrap with 1,000 draws to get rid of some of the serial dependence in our data. So when we do this, this is the picture that we came up with. Again, on the x-axis, you have the dummies that we set, so the subperiods. And on the y-axis, you have the average uncertainty relative to the control group for each subperiod. So in black right here, this line is what you've just seen. So basically the same analysis as before. So again, we see this U-shaped pattern of uncertainty, this build up and then decrease as we near the announcement time. And in green is what is more important or more interesting, I guess. This is where we include as a control the left and right tail uncertainties. And what we find is that starting on day -3, we see this downward trend, right? Relatively continuous downward trend. And very interestingly, at the announcement time, we see no resolution of uncertainty left. And the same basically emerges when we take the difference between the two graphs, which then isolates the tail impact in our setting. So the tail impact here is virtually 0 in the first 3 days of the blackout period, and then increases heavily as we near the announcement, going up as large as around 7%, which then drops almost completely as the announcement is made. So again, what we find is that this buildup in uncertainty and also the resolution of uncertainty at the announcement time seem to be both driven by this measure of tail uncertainty. And it's important to note here that the impact of the right tail is virtually 0. So this is all driven by left tail uncertainty. So the perception of downside risks going into a monetary policy announcement. We also confirm this idea by looking at the returns to straddle and strangle portfolios. I have no slide for this here, but essentially you find that there's a very, very large premium for being exposed to variation during this time, as large as 9% per meeting, and that this premium is comparable in size whether we try to insure against all variation in the underlying or just the variation stemming from tails. So again, it seems to be that this tail impact is really what drives this pattern of uncertainty here. Now, a natural objection here is that what we find, so that tail uncertainty increases heavily, could be the case for any other macroeconomic news release, So we next ask whether this tail impact is actually unique to FOMC announcements, and apply the same analysis that we've just seen to the three most important macro announcements. These are GDP growth, initial jobless claims, and non-farm payrolls as identified by a Bloomberg poll. And then for each of these announcements, we construct a pseudo blackout period, right? So we again look at whatever happens before the announcement to kind of compare these two analyses to one another. After various filters, for example, that none of these macro releases can fall within the blackout period of an FOMC announcement and some others, we're left with 221 macro announcements that we analyze here. And we then compare these 221 macro announcements with those FOMC announcements that do not have another macro release in their blackout period, which are 88 in our setting. Now, with this, looking at these macro releases, we try to answer two questions. So the first that I'm going to show here is whether this pattern is unique to FOMC announcements. And the second is that this pattern is not driven by other macro releases that may fall within the blackout period. And to do so, we compare these 88 meetings without another macro announcement in the blackout period to the remaining 24. And we again find that the results are virtually the same. There's some level shift there. So right here in the bottom panel, you essentially see the same pattern. So this is for these 88 FOMC meetings that I've just talked about. We again find this U-shaped pattern here. Again, there's a level shift. But when we account for the impact of tails, we find that there seems to be a very positive tail impact around FOMC announcements. Now, in the upper panel, this is, I guess, very much more interesting here. For other macroeconomic news announcements, we find that again, uncertainty levels are close to the control group in the first 3 days of the pseudo blackout period, but then continually decline. Right? We have no change between pre and post here because we set these to be equal since some macro announcements do not fall within the standard trading hours. And here in green, once we account for the impact of tails, what we find is that actually this purged estimate increases. So this suggests that for other macroeconomic news announcements, the tail impact is actually negative. And this suggests that relative to the control group, tail uncertainty declines faster than overall uncertainty does, right? So the complete opposite picture of what we find for FOMC announcements. All right, now to answer the second part of the question, so why does economic uncertainty react to these FOMC announcements? We now look at the connection between ex-ante tail uncertainty on the days -5 to -2, so the average on these days, in the blackout period, and the index performance around our target FOMC meeting. And we separately consider the pre-announcement drift here as a target return, the announcement response, so whatever happens after the announcement, and then the total return, which is just the sum of the two. We run regressions of the following form. We include the log of left tail uncertainty here to kind of deal with some outliers. But if we take the normal version of left tail uncertainty, the results are even stronger. And we also include a few controls. And these controls either include the part of economic uncertainty that is not already explained by left tail uncertainty, and signed intermediate returns, which follows Chieslak et al. In their 2020 paper, who show that looking at the return, the realized return between two announcements has predictive power over future target rate changes, and especially this negative. If this return had been negative, this suggests that future target rate cuts are more likely. If we do this, this is the picture that emerges. So on the left here, we find a very clear positive connection between our total announcement returns, so our total FOMC returns, so the pre-drift plus the announcement return, and our left tail uncertainty measure. This left tail uncertainty measure I forgot to mention this. This is standardized. So on average, we have a return of around 40 basis points per meeting in our sample. And for a 1 standard deviation increase in our log left tail uncertainty measure, this return would increase by 61 basis points. And if we now split this by whether this is driven by the pre-announcement drift or the post-announcement response, we find that it's virtually only the pre-announcement drift that drives this. So there seems to be a clear connection between the left tail uncertainty here and the pre-announcement drift. Right here in this table in the left model, model 1, we've included this orthogonal part of overall economic uncertainty. And again, we find very comparable results, right? So our orthogonal part of uncertainty does not have any influence on our meeting returns. And on the right, we now include the signed intermeeting returns. So whether the intermeeting return between the last and up to this meeting has been positive or negative, we find that they do not relate to the subsequent announcement return or the pre-announcement drift, but that our left tail uncertainty measures seem to play a key role here. All right. Now we've shown that there seems to be a connection between left tail uncertainty and the stock market in general, or the response to the upcoming FOMC announcement. We now want to further understand why this might be the case. And if the Fed uses uncertainty, and more importantly, this left tail or tail uncertainty in general as input to their decisions, then this left tail uncertainty measure should predict future rate decisions, right? And we simply use future rate decisions here as kind of a proxy for changes in policy. And we analyze these changes in the Fed fund target rate using the regressions from before, and we predict rate changes for horizons, so cumulative rate changes for horizons of up to a year or 8 meetings ahead. The results are shown here. So what we find is that for the next meeting, a 1 standard deviation increase in this left tail uncertainty measure corresponds to a 14 basis point cut, which is highly significant. For the next 2 meetings, the cumulative rate cut, the sum of the rate cuts between these 2 meetings is 23 basis points, and it goes up to 54 basis points, so quite large and still significant for 8 meetings ahead. If we include the signed intermeeting returns, we find that for the next meeting, our left tail uncertainty measure seems to be sufficient to understand target rate changes. But for longer horizons, we find that there is a clear positive relation here. So for more negative announcement returns, for more negative intermeeting returns, we find that the likelihood or the size of a rate cut at the future meetings is higher.
You have about 2 minutes left. Just
all right. Yeah, thank you. We also confirm this idea by looking at a logit model where we simply look at the likelihood of a future rate cut, and we find that it is higher for higher levels of left tail uncertainty. Now again, we look at a sample, a very restricted sample, where for a long time the target rate had been at the 0 lower bound, and all of the rate cuts basically are bunched up at the financial crisis. So we extend our sample for this part of the analysis using daily options data from 1996 through 2018. And this yields similar results whether we look at the whole sample or cut the sample short in 2007. So this seems to be not only driven by the financial crisis here. So to do, the last bit here is to try and integrate this into an existing theoretical framework. So the reason why tail uncertainty is elevated is definitely important here around these FOMC meetings. And we try to integrate our empirical results into the framework by Wagda and Zhu, who show that the FOMC periodically reveals important information about the state of the economy. And this information concerns the likelihood of economic disasters, and that there is a small probability that at the announcement the Fed releases that basically the economy is in a worse shape than expected, which then warrants a risk premium. And what we find is basically in line with this, right? So our left tail uncertainty indicator is definitely connected to the chance of disasters. right? Spiked in '08 and for the sovereign debt crisis in Europe. And we find that, or it should then be logical that expectations about this left tail uncertainty measure should be elevated shortly ahead of the meeting and then resolve once the information from the announcement or from the Fed is revealed to the public. So this seems to be in line with this. Now, to summarize, we've shown that there seems to be a connection between the perception of downside risks and ensuing meeting decisions and the reaction of the stock market. We find that uncertainty increases ahead of announcements, and there is a strong resolution of uncertainty as the announcement is made. And that both of these parts of the behavior are explained by tail uncertainty. This is unique to FOMC announcements and robust to many meeting characteristics, which I've not shown here, but we look at in the paper. And we also find that a higher amount of tail uncertainty positively predicts market returns, which we argue is likely driven by more accommodative monetary policy stance, because this left tail uncertainty measure also positively predicts cumulative future rate cuts of up to 8 meetings in advance. And that will be it for my side.
Thank you, Heiner. So our discussant is Emmanuel Macron, and can you
Yep, there you go.
Please share your screen. And for those participants who have questions, please feel free to type them into the chat box. Thank you.
Okay, can you see my slides?
Yes.
Perfect. Thanks so much for asking me to discuss this very interesting paper. I've enjoyed reading it a lot. Heiner did a great job summarizing the paper, so I will only skim over some of the, for my discussion, more important parts and will not give you a full recap of the paper. Now let me try to get to the second slide. So I'll start with a high-level summary and where I see the paper sort of fits into the broader literature, and then I essentially have 2 comments, or really one major comment, which is whether the findings that the authors document are about uncertainty more broadly, or really left tail uncertainty, which is how they sort of told the story in the paper. And then I'll conclude. I have a second comment with a small suggestion on how to disentangle uncertainty about FOMC decisions, looking at the term structure of options data. Okay, let me start with the high-level summary, though. So the paper studies uncertainty around FOMC announcements. It documents an increase in uncertainty several days ahead of FOMC meetings, which then is resolved at the announcement time. The paper argues that this is primarily driven, this increase, and also then the resolution of uncertainty at the announcement is primarily driven by left tail uncertainty. The authors document that the strategy that ensures investors against this tail risk delivers strongly negative returns, which means that it's basically costly to insure against this tail risk. And they also show that uncertainty, or left tail uncertainty, primarily predicts FOMC day returns, including those earned ahead of the announcement, and also economic outcomes, as well as the Fed's surprises. Now, let me sort of summarize a little bit what we know from the literature so far and where this paper sort of fits into the broader literature. What we know is that on FOMC days, stock returns move in potentially quite puzzling ways for asset pricing. So here's the main chart from the paper by myself with David Luca in 2015, which shows the cumulative minute-by-minute S&P 500 over a 3-day window, starting on the morning of the day before scheduled FOMC meetings and ending on the close of business on the day after scheduled FOMC meetings. And you see that basically over this 3-day window, stock returns increase by about 50 basis points per meeting. Now, what's interesting is that this increase is essentially happening ahead of the FOMC announcement. And this is sort of what we label or dub the pre-FOMC announcement drift. So stock returns in the US, and we've shown this is true also in other major stock market indices, stock prices creep up ahead of the FOMC announcements on average. Then at the FOMC announcement, there's, depending on the sort of sign of the surprise, if you will, there's positive or negative reactions, but on average, they essentially wash out. And so on average, after the FOMC comes out with its announcement or decision, stock prices are flat. And these stock returns are very economically significant. 50 basis points per meeting is about 4% per year, which over the period where we document this corresponds to about 80% of overall realized returns. We're careful not to label this the equity, 80% of the equity premium, because we're still skeptical this is really a risk-based story, but it could be. So, so I think that's the sort of broader literature. On all other days, on average, over the sample period, stock returns were essentially flat. So there's this large excess return, there's a number of sort of additional facets of the empirical results that we document in our paper, and others have also contributed to documenting, that I think are important for teasing out what's really going on around FOMC announcements in the stock market and markets more broadly. So we find that the returns are not reversed after the announcement. There are no such returns ahead of other macroeconomic announcements. The pre-FOMC returns are not correlated with the Fed decision, and there are no such returns in bonds. We also document in our paper that there's low volatility, realized volatility, and also low trading volume just ahead of the FOMC announcements. And we document that the pre-FOMC returns are somewhat higher when the VIX is high, but the VIX alone, the level of the VIX ahead of the meeting, cannot explain much of the variation in pre-FOMC returns. Now here's this documentation from our paper again on realized volatility around FOMC meetings. So you see the typical sort of U-shaped evolution of volatility, high in the morning, high in the evening, very low around lunchtime. You also have that on FOMC days, here the middle panel again. But on FOMC days, volatility tends to be a little lower still than on typical days, this thin black line here. And then of course it jumps up at the announcement and then sort of resides or dissipates towards the end of the day. And then on the day after, realized volatility again, and this is here from the S&P 500 E-mini futures, is about the same as on typical days. So volatility is quite low ahead of the meeting, jumps at the announcement, which suggests that information is being revealed at the announcement. Hyun Pan and co-authors have documented something a little different for the VIX. And so they have shown, and that's been confirmed in the paper by Heiner and co-authors, that essentially ahead of FOMC meetings, at least those with a large positive return, the VIX tends to creep up over a few days and then essentially drops on the day of the announcement, already starting before the announcement and then dropping further on the day after the announcement. Okay, so where does this paper come in? So far, in my humble opinion, there's no satisfactory explanation for this pre-FOMC drift. For a reason that I don't really understand, and that's puzzling to me, the literature has focused a lot on leakage-based explanations of the drift, but leakage is really not plausible for various reasons. Let me just tell you three. First, there's no pre-FOMC drift in bonds. So any leakage-based story of the pre-FOMC announcement drift would have to explain why we see this huge drift unconditionally in equities, but not in bonds. Implausible that the Fed somehow manages to leak systematically information to global stock market traders and somehow bond market traders don't learn about this. Second, we don't see a correlation between pre and post FOMC returns. If this was really about leakage of information, you would expect to see a correlation between the returns earned ahead of the announcement by those who found out before through the leakage, and post the announcement by those who then essentially just only learned about the news. No correlation in the data strongly suggests there's no leakage. Also, if anything, the pre-FOMC drift is actually higher ahead of negative Fed surprises. Another argument for why leakage is not an explanation of the pre-FOMC announcement drift. So there's many more reasons actually. So I just urge the literature to forget about this leakage story. And by the way, the nice paper by Jessica that Heiner mentioned, which sort of tries to understand how a premium could arise on announcement days, also can only explain a pre-FOMC announcement drift with the assumption of there being information leaked ahead of the announcement. So while it's a nice story, again, it will not be able to explain the pre-FOMC announcement drift. Turns out the pre-FOMC drift is alive and well after 2011, at least ahead of meetings with press conferences by the FOMC chair. So if it was just a behavioral thing, then it should have gone away, maybe over time. There's been 9 years since we for the first time documented this drift, and it's still alive and well, at least ahead of these meetings with the press conference. So there seems to be something maybe more than just behavioral going on, and potentially there is a risk-based explanation. And if there is such a risk-based explanation, we should find clues involved. So I think the authors are spot on. They look in the right place. We need to find out what's going on in volatility and uncertainty if we want to understand what this drift is about. Now, data and measurement, Heiner did a great job summarizing what is being done in this paper. They use S&P 500 options quote data from the CBOE minute by minute, which is very nice because it allows us to zoom into the FOMC meeting days from 2004 to 2017. Has 112 scheduled meetings, and also, of course, looks at the blackout periods ahead of these meetings. Their measure of uncertainty focuses on 30-day ahead volatility or implied volatility using a quadratic variation type of measure. They follow Tim Boleslev and co-authors by measuring tail uncertainty, and then normalize uncertainty and tail, left and right tail uncertainty with respect to the average of the same measure over the 30 days preceding the blackout period they look at, but focusing on the same intraday time. So they basically just normalize the measures of uncertainty with respect to a 30-day period right before the beginning of the blackout period, so the week before the scheduled FOMC announcement. And then with this sort of normalized measure, they essentially also find something very similar as in Hyun Pan's paper, that uncertainty seems to be creeping up a couple of days before the FOMC announcement quite substantially, and then sort of drops on the morning of FOMC announcements, and then drops even more sharply with the announcement. So the announcement, the FOMC announcement, reduces or resolves uncertainty, but some of the uncertainty seems to be already resolved before the announcement. Yet what seems to be resolved is actually uncertainty that sort of was maybe to some extent artificially increased through the existence of an announcement. What do Heiner and co-authors add to this? They basically run a dummy regression of their normalized or difference uncertainty measure on dummies around FOMC announcements, disentangling the pre and post announcement day returns. And here you basically just see again the same pattern. Uncertainty increases ahead of the announcement and then is resolved on the announcement day. However, when controlling for tail uncertainty, they find a quite somewhat different result. Basically, if you then include measures of left and right tail uncertainty in the same sort of regression, the left tail uncertainty explains a lot of the variation in uncertainty overall, and what's left for the dummies is just a little uptick in uncertainty up to 3 days ahead of the announcement, which then sort of declines coming into the announcement day. So there's no uncertainty resolution, if you will, left. There's, if anything, there's uncertainty resolution earlier, and it's quite a bit smaller.
Emmanuel, just
yes.
You have about 2 minutes left, less than 2
Thank
minutes.
you. Yes, thank you. They also then show that there's a hedging strategy that sort of is quite expensive. Now, my main comment is that I don't really believe, and Heiner was kind enough to send me the data, that this is really about tail uncertainty. The uncertainty measures that they produce are highly correlated, especially the overall uncertainty, left tail uncertainty. It's 95% correlated in the data that Heiner sent me. So really, these things move up and down together in lockstep, and there's very little sort of information in left tail uncertainty that's not already contained uncertainty. If anything, there's a really strong factor factor structure in the different uncertainty measures. So what happens if we purge left tail uncertainty from overall uncertainty and then run the same dummy variable regressions? Well, if we do this, then there's essentially a decrease in uncertainty ahead of the or left tail uncertainty ahead of the FOMC announcement, then an increase just before, and then it basically stays flat around the FOMC announcement. So left tail uncertainty is lower a couple of days before, but rises just ahead of the announcement if we purge it from overall uncertainty. And so if you then superimpose the three different types of dummy regressions, we see that basically if I purge left tail uncertainty from overall uncertainty, I'm back to something similar to what's the base scenario without any sort of orthogonalization. So really, I think the result in the paper strongly depends on the order of orthogonalization of tail and overall uncertainty. And so I'm asking myself, can you identify maybe shocks to left tail uncertainty and study their effects on asset prices around FOMC days, or sort of disentangle left tail uncertainty more cleanly from the options data that you have than you're currently doing. And then, of course, this sort of high correlation also shows up in the second part of the paper, where they show that the pre-FOMC returns, but also the Fed surprises or Fed rate changes are predicted by left uncertainty. We can basically run the same regression of pre or post FOMC day returns on left tail uncertainty in the orthogonal component, basically corroborating the findings in the paper. Once I inverse the order of orthogonalization, and basically I purge uncertainty from left tail uncertainty, left tail uncertainty from uncertainty, then there's no predictability yet. So while on their own, both the VIX uncertainty and left tail uncertainty all predict pre-announcement returns, the component specific to left tail uncertainty, this LU orthogonal, does not. And of course, a huge intercept also remains in these regressions. If anything, uncertainty only explains a small share of pre-FOMC returns, which is something that we've also shown in our paper. So it's not true that uncertainty alone can explain these returns. So if anything, they explain only a small share. There's a huge intercept that remains. Okay, comment two, I think you should try and use the term structure of uncertainty that your data has more. There's a nice paper by Bundy, Carriford, and Smith that do a similar exercise based on Eurodollar options with a different aim, but I think this is something that you should maybe look a bit into. In summary, I think this is an interesting paper that aims at an important question. It documents some build-up and some resolution of uncertainty around FOMC meetings. But I'm not sure this is really about tail uncertainty, as the authors argue. I think more work needs to be done, and you have the very nice granular data to do so. So I urge you to do more, and I look forward to seeing this in the future version of the paper. Thank you.
Thank you very much, Emmanuel. I'm going to give Heiner a few minutes to quickly address our response to the comments from discussants, and then we'll open the floor to the participants online. And please feel free to type in any questions that you have. Go ahead, Heiner.
First off, thank you so much for going over all that data and actually looking into our analysis in detail. The one comment you had about the intercept and the regressions and the return regressions, these intercepts are basically the unconditional returns during that time, because I don't know if we actually state this in the paper, we should, we standardize our estimates, so our uncertainty measures for this type of regression. So this is likely why it is so large, but to be honest, I've never looked at the flat effect. Trying to really look at the intercept when we don't do this standardization. Thank you so much. The orthogonalization, we will definitely have to look at this a lot and really understand, okay, where is this coming from, and especially why is it that the left tail uncertainty seems to have predictive power over stock returns, while the uncertainty itself does not when reversing the ordering. So there still seems to be a lot of work that we have to put in. And one thing about the term structure, we have looked at this, And there are definitely interesting effects in the term structure of uncertainty around these FOMC announcements, especially when, you know, we took the analysis that you've just seen and basically just plugged in various longer term uncertainty measures and also shorter term. And you do see a lot of variation here. We decided to, you know, kick it out of the paper to make it more concise and focus on this tail uncertainty estimates. But I agree, this could definitely be important to look at, especially you know, using weekly options data at a high frequency to really understand, okay, what is happening around these FOMC announcements. So thank you very much. Thank you for the discussion. Thank you.
Thank you very much, Heiner. And at this point, I would like to invite any participants to unmute themselves if you have any questions for the presenters. Anyone from participants from the audience? Okay. Well, I have a question while no one's asking. In terms of think about the alternative explanation or a story, is there a potential pre-scheduled announcements on days where there's an increase in uncertainty, but there is no increase in tail risk? So my question is generally is that the intuition you would expect the uncertainty to increase because of the tail risk. Mm-hmm. What would be the counter argument or other scheduled announcement dates where such thing won't happen? Do you have any thoughts on that?
Well, only for the other macro announcements, right? What we've seen there is that going into these announcements, we see that uncertainty generally declines in the days before the announcement, seemingly. And we find that this left tail uncertainty measure seems to decrease even faster compared to the control group, right? So we are here not comparing the time series measures of these uncertainty measures or the time series dimension, but we're looking at these diffed measures. So it's a bit different, really, and it kind of suggests that for other macro announcements, left tail uncertainty seems to decline faster than uncertainty, you know, going into these announcements. But for FOMC announcements, the pattern that we show is pretty robust, right? We check this against a lot of different meeting characteristics. So I'm not quite sure. I don't know from the top of my head whether there are any meetings where, you know, tails do not move, but uncertainty does, or uncertainty does not move, but tails do. So that would be interesting to look at.
Okay. Any other questions from the participants? Please feel free to unmute yourself.
Well, I will ask a quick one. So in a couple of weeks, actually in a month, we're going to have Sang Byung Seo present a paper at the VDW where he argues that some of the results that we have seen today